Welcome to our comprehensive guide on loan origination and underwriting. In this video, we'll walk you through the entire mortgage process, from the initial application to closing, and explain the key terms you'll encounter along the way. Whether you're a first-time home buyer or looking to refresh your knowledge, understanding these concepts is crucial for making informed decisions. Let's begin by exploring who's involved in the mortgage process and what their roles are, setting the stage for a smooth home loan experience. Mortgage loan originator is your main point of contact when you start the home loan process. This can be an institution or an individual, such as a mortgage broker or banker. Their job is to work with you from the moment you apply until your loan closes, gathering all necessary documentation and guiding your file through approval. Importantly, only the mortgage loan originator can discuss rates and terms with you, ensuring you get accurate and up-to-date information about your potential loan. You might hear about mortgage brokers and mortgage bankers. A mortgage broker acts as a middleman, connecting borrowers with lenders but doesn't fund loans themselves. They help you find the best lender for your needs. On the other hand, a mortgage banker originates mortgages and uses their own funds or borrowed funds to finance your loan. Knowing the difference can help you decide which professional to work with based on your preferences and financial situation. Mortgage application is your formal request for a home loan. At this stage, you provide essential information about your finances, employment, and the property you wish to buy. It's important to note that this is just the initial application, not a completed one. A completed application comes after you have an accepted contract on a property. The details you provide here set the foundation for your loan approval journey. Requalification is an informal step where the lender estimates how much you might be able to borrow. This is based on information you provide about your credit, income, debts, and assets. It's a quick way to get an idea of your price range before you start house hunting. Remember, pre-qualification is not a guarantee of a loan, but it helps you understand your potential borrowing power. Pre-approval is a more formal process than pre-qualification. Here, the lender reviews your financial documents and credit history to determine exactly how much you can borrow. You'll receive a pre-approval letter which shows sellers you're a serious buyer. Many lenders consider pre-approval the first official step in getting a mortgage, and it can give you a competitive edge in a hot housing market. Loan commitment is a formal notification from your lender that your loan has been conditionally approved. This document outlines the terms under which the lender agrees to make the loan. It's an important milestone as it means you've cleared most of the hurdles and are close to final approval. However, there may still be conditions you need to meet before closing. Applying for a mortgage, you'll need to provide proof of income. Two key documents are the W-2 and your pay stubs. The W-2 is an annual wage and tax statement from your employer, showing your income and taxes paid. Pay stubs, on the other hand, are provided with each paycheck and detail your earnings, deductions, and hours worked. These documents help lenders verify your income and employment stability. Net worth is a simple calculation, your assets minus your liabilities. Lenders may also ask for financial statements like a profit and loss P&L statement or a balance sheet, especially if you're self-employed. The P&L summarizes your income and expenses over a period, while the balance sheet lists your assets, liabilities, and net worth. These documents give lenders a clear picture of your financial health. Down payment is the amount you pay up front toward the purchase of your home. The rest is covered by your mortgage. Lenders also look at your reserves, savings that remain in your account after closing. These reserves act as a safety net, assuring lenders you can keep making payments even if your income drops. Typically, you'll need enough reserves to cover at least 2 months of mortgage payments. Par interest rate is the rate at which the lender doesn't charge any points, essentially a break-even rate. If you want a lower rate, you may pay discount points up front. The average prime offer rate (APOR) is a benchmark based on average rates and terms offered to low-risk borrowers. Lenders use APOR to help set competitive rates and ensure compliance with regulations. Debt is any arrangement where you borrow money with the promise to pay it back, usually with interest. When applying for a mortgage, lenders will review all your debts, including credit cards, car loans, and student loans. They want to ensure you can handle the additional responsibility of a mortgage payment without overextending yourself financially. Credit documents are essential for your mortgage application. They include credit reports, employment verification, income, and asset documentation. Lenders require these documents to be recent, no more than 120 days old. A charge-off, meanwhile, is when a lender writes off a debt as uncollectible. It's important to address any charge-offs on your credit report before applying for a mortgage. There are two main types of bankruptcy that can affect your mortgage application: Chapter 7 and Chapter 13. Chapter 7 involves liquidating assets to cancel debt and can stay on your credit report for up to 10 years. Chapter 13 sets up a court-monitored payment plan, allowing you to keep property if you stick to the plan. This type remains on your credit report for up to 7 years. Both types impact your ability to qualify for a mortgage. Debt-to-income ratio, or DTI, is a key metric lenders use to assess your borrowing risk. It's the percentage of your gross monthly income that goes toward paying debts. There are two types: the front-end ratio, which looks at housing expenses, and the back-end ratio, which includes all debts. Keeping your DTI low increases your chances of loan approval and better terms. Many lenders use an automated underwriting system, or AUS, to streamline the loan approval process. This electronic system reviews your application and generates a loan decision quickly. While AUS speeds things up, a human underwriter still reviews your file to confirm all conditions are met before final approval. The underwriter is the person who ensures you meet all loan requirements. They assess your income, employment, credit history, debt-to-income ratios, and assets. The underwriter also reviews the property's appraisal to confirm it's worth the purchase price. Their job is to approve or deny the loan based on risk and compliance with lending guidelines. Underwriting conditions are requirements you must meet before your loan can close. These may include providing additional documentation, a letter explaining a large bank deposit, verification of homeowner's insurance, or gift letters if you're using gift funds. Meeting these conditions promptly helps keep your loan on track for closing. Lenders use four main factors, often called the 4Cs, when underwriting a loan: capacity, capital, credit character, and collateral. Capacity measures your ability to repay based on income and debts. Capital looks at your financial resources, including cash for closing and reserves. Credit character is based on your credit history and willingness to repay. Collateral refers to the property itself, verified by an appraisal. Lenders review your payment history on mortgages or rent for the past 12 months. They also require a minimum of 2 years of employment income history. If you rely on overtime or bonuses, you'll need at least 12 months of stable income for conventional loans and 24 months for FHA loans. Be prepared to provide recent pay stubs and W-2s covering the last 2 years. If you're self-employed, lenders require at least 25% ownership in your business. You'll need to provide 2 years of personal and business tax returns, along with a profit and loss statement and a balance sheet. These documents help verify your income and business stability, ensuring you meet the requirements for a mortgage. Rental income from investment properties can be used to qualify for a mortgage. Lenders typically count 75% of the rental income, accounting for potential vacancies. Public assistance income, such as Social Security or child support, can also be used and is grossed up by 25%. These sources are considered during the underwriting process to determine your total qualifying income. Seasonal workers, such as teachers or construction workers, may use unemployment income if it's part of their regular work cycle. Lenders require proof of this income on your last 2 years' tax returns. For retirement, pension, child support, or alimony to count as income, it must be expected to continue for at least 3 years beyond the application date. Lenders may require you to sign IRS Form 8821 or 4506C to authorize them to review your tax information. Form 1040 is used to file your annual income tax return. These forms help lenders verify your reported income and ensure all information matches your application. All recurring debts, such as mortgages, student loans, car loans, credit cards, and personal loans, are considered in your monthly obligations. If you have installment debts with 10 or more payments remaining, they must be included. Lease payments are always counted, and if a revolving debt doesn't show a minimum payment, lenders use 5% of the balance as the monthly payment. If your credit report doesn't list a monthly payment for student loans, lenders use a standard calculation: 1% of the balance for Fannie Mae, 0.5% for Freddie Mac and FHA. This ensures your potential payment is factored into your debt-to-income ratio, even if you're in deferment or forbearance. Lenders consider both traditional and non-traditional credit histories. Traditional credit comes from credit bureaus, while non-traditional credit includes things like rental payment history, utilities, and insurance payments. If you lack traditional credit, providing 12 months of non-traditional credit can help you qualify for a mortgage. Gross monthly income is calculated based on your pay frequency. For example, annual income is divided by 12, weekly income is multiplied by 52 and then divided by 12, and so on. Lenders use this figure to determine your ability to repay the loan and set your borrowing limits. The loan-to-value ratio, or LTV, compares the loan amount to the property's appraised value or purchase price, whichever is lower. A higher down payment results in a lower LTV, which can improve your loan terms. Lenders use LTV to assess risk and determine if mortgage insurance is required. Combined loan-to-value (CLTV) and high credit loan-to-value (HCLTV) ratios consider all mortgages and home equity lines of credit on a property. CLTV adds the balances of first and second mortgages, while HCLTV includes the full credit line of a HELOC. These ratios help lenders evaluate the total risk associated with the property. Basis point is 1/100 of a percentage point, often used to describe interest rate changes. Discount points are upfront fees you can pay to lower your interest rate. Each point costs 1% of the loan amount and typically reduces your rate by 0.25%. Understanding these terms helps you evaluate your loan options and potential savings. A temporary buy-down is an incentive often offered by sellers or builders. It involves paying mortgage points or a lump sum into escrow to temporarily reduce your monthly payments. This can make your initial payments more affordable and help you ease into homeownership. Origination points are fees charged by the lender for processing your loan. These are usually lumped together as origination fees and are paid at closing. 1 point equals 1% of the loan amount, or 100 basis points. Understanding these fees helps you compare loan offers accurately. A lender credit is when you agree to a higher interest rate in exchange for the lender covering some of your closing costs. This reduces your upfront expenses but increases your payments over time. It's a trade-off that can be useful if you're short on cash at closing. Mortgage interest is paid in arrears, meaning each payment covers the previous month's interest. The annual interest is calculated by multiplying the loan amount by the interest rate. Monthly interest divides this by 12, and daily simple interest divides by 365. Understanding these calculations helps you track your payments and interest costs. Per diem interest is the daily interest you pay from the day you close until the end of that month. Your first mortgage payment is usually due on the first day of the second month after closing. At closing, you'll pay prorated interest for the days between settlement and the start of the next month. Principal balance is the amount you borrow, while the interest rate is the cost of borrowing that money. The principal is part of your monthly payment along with interest, taxes, and insurance, often called PITI. The interest rate can be fixed or floating, affecting your monthly payments and total loan cost. Floating interest rate means your rate isn't locked in and can change with the market. A rate lock, on the other hand, is a commitment from the lender that your rate won't change for a set period, usually 15, 30, or 45 days. Locking your rate protects you from market fluctuations before closing. A rate lock agreement is a written contract between you and the lender. It specifies the locked interest rate, the effective date, any costs, and the expiration date. You can rescind the agreement until the lender signs and sends it to you. Make sure you understand all terms before committing. If you receive a gift to help with your down payment, you'll need a gift letter. This letter must include the donor's name, relationship, amount, date, and a statement that repayment isn't expected. The donor's bank information and signature are also required. Proper documentation ensures the gift is accepted by the lender. Gift funds can come from relatives such as a spouse, child, or other family members by blood, marriage, or adoption. Non-relatives with a close relationship like a domestic partner or godparent may also give gifts. However, parties involved in the transaction like builders or agents cannot provide gift funds. Mortgage payments are due on the first of each month with a 15-day grace period. If you pay after the 15th, a late fee is charged. Staying on top of your payment schedule helps you avoid penalties and keeps your credit in good standing. We've covered the key steps and terms in the loan origination and underwriting process. From application and pre-approval to underwriting and closing, each stage involves important documentation and decisions. Understanding these concepts empowers you to navigate the mortgage process confidently and make informed choices for your financial future. To ensure a smooth loan process, keep your financial documents organized, respond quickly to lender requests, and avoid making large financial changes before closing. Staying proactive and informed can help you avoid delays and secure the best possible terms for your mortgage. Congratulations on reaching the end of our mortgage origination and underwriting guide. Now that you understand the process and key terms, you're better prepared to start your home buying journey. Remember, working with knowledgeable professionals and staying organized will help you achieve your goal of homeownership with confidence.